So let's talk about something that happened on February 26th, 2026, because fintech giant Block drops two pieces of news that, on the surface, make absolutely no sense together. It's a paradox that is pretty much the entire tech and finance world scratching their heads.
Okay, so let's just break this down. Get this. On one hand, Block comes out and posts these amazing fourth quarter numbers. Their gross profit is up a massive 24%. Fantastic, right? But then in the very same announcement, they say they're cutting over 40% of their entire team. I mean, how do those two things even exist in the same reality?
So you've got record profits happening at the exact same time as these radical cuts. It raises a huge question, and that's what we're going to unpack in this explainer. How is this even possible? And more importantly, what does this move signal for the future of tech? All right, let's dive in.
First, let's look at the good news side of the story. We're going to explore the bull case. This is Block's argument for why this isn't a sign of trouble at all, but actually a brilliant strategic move.
The whole bull case, their entire argument, really starts with this number, $2.87 billion. That's a record gross profit for them in the fourth quarter of 2025, and it's that huge 24% jump year over year. You really can't argue with that kind of strength.
And they're not expecting this to be just some flash in the pan. Management actually raised their guidance for 2026. They're projecting a massive 54% growth in adjusted earnings per share. I mean, that signals some serious confidence in their new, much leaner structure.
Now, to put this into perspective, let me tell you about a key metric in the software world. It's called the Rule of 40. It's basically a benchmark for elite companies. Your growth rate plus your profit margin should add up to 40% or more. Well, Block is projecting they'll hit 44% in 2026, so this isn't just good, it's a signal to investors that they are operating at a really high level. So here's the crucial point, right? How do they connect this incredible growth to these massive layoffs? Well, CEO Jack Dorsey puts it very plainly. He argues this is a deliberate pivot to what he's calling an AI-native company. The core idea here is that artificial intelligence has fundamentally changed the game. Think of it this way. A few years ago, you might have needed a huge team to build something big. Now, Dorsey's bet is that with AI tools, a smaller, way more focused team can actually be more productive and more innovative than a much larger old-school workforce. He's betting that AI is the key to doing way more with way less.
Okay, but that's just the bull case. That's the rosy picture. Now let's flip the coin and look at the bear case because, critics are looking at the exact same information and coming to a very different and frankly, a much more worrying conclusion.
Now take a look at this chart. This right here is what has analysts so worried. As Block has ramped up its lending business, its losses from bad loans have more than doubled in just 1 year. That's a 108% increase. For a lot of people watching the company, that is a massive, blinking red flag.
And the source of all this new risk? It's no secret. It's because Block is leaning really heavily into consumer lending with its super popular Cash App Borrow feature. And while, yeah, it's a very profitable area for growth, it also comes with a much, much higher risk that people just won't pay those loans back.
And this table kind of lays out the other big concerns people have. First, there's just pure execution risk. Can a company that just lost over 4,000 people, all that institutional knowledge, really keep innovating at the same pace? Then you've got the wild card of Bitcoin. A $250 million loss in Q4 alone just shows you how wild the swings in their earnings can be. And finally, there's the pressure on their cash flow from pouring $3 billion into that risky lending business.
So, you've got this really compelling bull case on one side and this very real, kind of scary bear case on the other. With these two competing stories on the table, what was the final verdict from the market?
Initially, investors went absolutely crazy for it. The stock shot up 24% in after-hours trading right after the news dropped. I mean, that is a massive thumbs up for the cost-cutting and that big pivot to AI.
And this wasn't just a one-day thing, a knee-jerk reaction. As you can see from this chart, the feeling on Wall Street is overwhelmingly positive. You've got almost 80% of analysts rating Block as a buy or a strong buy. They are clearly buying into Jack Dorsey's vision for the future.
But, and this is a really crucial piece of context, despite that short-term pop, if you zoom out, the stock has been a massive underperformer for a long time. It's down over 15% in the last year and a staggering 76% over the last 5 years. And that is exactly why this move is seen as so important. It's this dramatic attempt to finally turn the whole ship around.
And that brings us right back to the central tension of this whole story, the big question at the heart of what Block is doing.
So you're left with two completely different ways to look at this whole thing. Is it a brilliant pivot,
a really forward-thinking strategy to build a leaner, meaner AI-powered company of the future? Or is it a brash, high-stakes gamble that could totally backfire with poor execution, those rising loan defaults, and losing key talent?
Ultimately, Block's bold, paradoxical decision forces all of us to ask a much bigger question. In this new age of AI, is this the new playbook for tech companies? You prove you can achieve massive growth, and then, instead of hiring more, you make massive cuts to chase even higher levels of efficiency. The answer to that could really redefine corporate strategy for years to come.